The types of returns that's going to make sense for you are going to vary. It's going to vary based on the location. It's going to vary based on the property type. Certain locations like Manhattan and Los Angeles are going to have lower rates of return than Indiana. And so now you got to understand, depending on what type of return that you want, you got to vary where you're investing your money, and it's also going to depend on what type of properties you're looking for. If you want to see the higher rates of returns, you got to look at the more distressed properties because that's going to require more work to get a property turned around. If you just want a steady cash flow, you don't have to put in any work, you're going to expect some lower rates of returns as well. And the way that you calculate this is by doing a simple calculation. You take your rental income, then you subtract your property taxes, your insurance, your maintenance costs, because I don't care how nice a property is, you always want to factor in some maintenance costs, subtract your management fee. Even if you're not going to manage your property yourself, add in a management factor, add in a management cost, because if you wanted to hire somebody else, well, there's going to be a fee to that. And when you go to sell this property, every investor is going to assume that there's a cost for management. And even if you're not paying yourself as a manager, the other investors will, and they're going to factor that cost in there when they're deciding how much money to pay you. So always factor in a management cost. And then I always like to factor in a vacancy cost as well, because I know the tenants move out and you want to factor that cost in there. And if you can be generous on your expenses and still have a strong profit, well, then you can make money when the expenses are lower than what you expect. I want my real expenses to be less than my expected expenses, because then I'm not going to be upset. But if my real expenses are higher than what I expected, that's going to make me a little bit more upset. And this is how you want to now run your analysis. Now, there's a lot of rules of thumbs that you can use here, and it's going to vary city to city, state to state. But here's a general rule of thumb that you might see. Your property taxes might cost you around 15% of your monthly rental income. Your property insurance might cost you another 5% of your monthly rental income. Your maintenance might be around 8%. Your management, another 8%. And then vacancy, another 8%. What does this translate to? Every year, about 1 month of rent for vacancy, 1 month of rent for your management fees, 1 month of rent for your maintenance costs, and then almost 2 months of rent for your property taxes, and a little bit less than 1 month of rent for your insurance costs. Now, is this guaranteed how it's going to always be? Absolutely not. Certain states are going to have higher insurance costs than others, but this gives you a rough idea. And this now will give you what's called your net operating income. Some people like to call this the back of a napkin calculation, because you can do this very quickly. And essentially what this is telling you is if you take your rental income and you essentially cut it in half, that gives you your net operating income. Now you might be saying, well, Jaspreet, what if I have a mortgage? What if I have debt? This is where you would now subtract your mortgage after the net operating income. Now, what I've seen, especially in 2021 and 2022, when we were seeing the big boom in the housing market, is a lot of people were investing in real estate with negative NOIs, with negative returns here, meaning they had to pay money every single month to keep these properties because they were cash flow negative. But the reason why people kept buying these deals was because they were hoping that they'd be able to sell these properties for a huge profit in 2 to 3 years. That's not the game that I play. And the game that I play is I want this NOI to give me a 7% cash on cash return on my money. Meaning if I invest $100,000 of my own cash, I want $7,000 worth of NOI, $7,000 worth of profit every year after paying for my expenses. That is a good return for me. Now, in order for me to justify this 7% NOI, I'm not just going to buy this in any random neighborhood. I want this to be in an area where I believe the populations are growing, where I believe businesses are moving to, where I believe people are wanting to move to, where I believe the money is moving to, because that's going to help increase the rental incomes in the future and also increase the property values. Now, for me, property value increase is like icing on the cake. It's great if it happens. If it doesn't happen, oh well, because I still have the 7% cash on cash return, and it also gives me cushion. Because now if we see a recession tomorrow, and now we have to cut rents, well, I still have margin in the deal to cut the rents and still be profitable. That's the game that I play. Because for me, this is a passive investment. And what I mean by that is I take the money that I'm earning, I put some of it aside, and then I invest this money into real estate. Now I buy this real estate and I have it managed by a property manager. Now I don't like the idea of managing my own real estate. That is not something that I do. That's not a game that I want to play, because My time is not very well served as a manager. I don't want to have to dealing with tenants. I don't want to have to deal with fixing toilets. I don't want to have to deal with talking to contractors and talking to the city hall. It's a pain in the butt for me, and I would not want to do that. But I can hire a property manager who is good at that. But you're going to have to be able to hire and fire property managers when you see fit. I've had to fire many property managers because sometimes they're good and then they become not so good, and you have to make sure you stay on top of the property managers. But the goal here now is you got to figure out what is this percentage number for you. And this is going to depend on where you're buying and what you're buying. Once you can determine what this percentage is for you, now you just do the math. You take how much money you need every single year to make this number X. Is it $50,000 a year, $100,000 a year, $1 million a year? You divide this number by the percentage that you can generate, cash on cash, and this tells you how much money you have to invest today to get that return. So if you want $100,000 a year and you get a 7% return on your money, you have to invest $1.42 million in order to generate that return. And now you can mess with the numbers to see how much money you need in order to be able to live off your rental real estate. But again, you don't got to buy everything this year. You can buy it in phases as you generate more income. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.